Okay. Hi, everyone. Hi again. If you have already been here, like I said, hi again. And if you just joined us, then hello, welcome, and thank you so much for joining us. Um, this slide is up because this is the just flyer for the event. If you would like to take a screenshot of it while I have it up for a few seconds, if you would like to just grab the registration link, type that into your browser, feel free. This is a three-part series. This is part two that you're joining in on. So yeah, all right. So my name is Ariana Baldwin. Thank you so much for joining us. I'm the Senior Coordinator of Outreach and Partnerships at Grow Brooklyn. And again, just really want to reiterate, thank you for joining us, taking the time out of your evening, your busy schedules, coming in from work, wherever you're coming in from, wherever you're calling in from. We appreciate you taking the time in this hour to spend with us this evening. All of us on this call believe that an educated, a well-informed, and a properly equipped community is a community that will prosper, but sometimes it can be a little difficult to find the resources that can allow for that prosperity. And we all know that tax season in the United States can be stressful, it can be complicated, and it can be confusing for many of us, and for many different reasons. But the biggest reason being that there's a lot of information out there that we are expected to know and that we need to know about taxes. It can be overwhelming to feel like you have to know all these different deadlines, all these different rules, regulations, requirements, and whatnot, and fear that if you don't, then you'll have to deal with the wrath of the IRS. Everyone is terrified of dealing with the IRS. And that leaves so many of our community members, and even those of us that are in the field, wondering if filing your taxes is something that you're supposed to do every year, then why is it made to be this confusing, almost hassle that we deal with every year, a time of year, tax season that people don't quite look forward to? And that's exactly why Grow Brooklyn and Brooklyn Legal Corporation A, which you'll interchangeably hear referred to as BKA or BK Legal during this presentation. That's why we came together to host this event, put this event together for the community. And as you can see, we're calling it the Need to Know 2022 tax season. Together, we made it our goal to break down and simplify all the most important tax information that we believe that you will need in order to make this the most worry-free, stress-free, uncomplicated, and perhaps even a peaceful tax season. Over the course of 3 weeks, beginning last week and ending next week, our group of tax attorneys and experienced tax professionals will be going over these 9 topics that you see in the yellow box on your screen right now. We'll be going over these 9 topics, we covered 3 last week, we're covering 2 tonight, and we're going to cover another 3.5-ish, kind of 2 topics next week, with allowing for the opportunity for you guys to ask your questions. It's not very often that you get to have tax attorneys and tax professionals essentially at your disposal to ask them whatever questions you need answered. So we do want to allow for that space and make sure we're prioritizing that space. I do want to also mention that being that BK Legal and Grow Brooklyn are proud to have their roots in Brooklyn, even though we serve the greater population of New York City, we're especially proud and grateful to have the support and sponsorship of 3 Brooklyn-based elected officials. Last week, we had the pleasure of kicking off part 1 with New York State Senator Roxanne Persaud, who represents New York's 19th senatorial district, which consists of Southeast Brooklyn and parts of Queens. Next week, we'll be having, for part 3, we'll be joined by New York State Assemblywoman Farah Souffrant-Forrest, who represents New York's 57th Assembly District, and that consists of parts of Northwest Brooklyn. And last, but certainly not least, tonight for part 2, we are thrilled and immensely grateful to have the support of Councilmember Crystal Hudson, representing parts of Northwest Brooklyn, as well as parts of Central Brooklyn in New York City's 35th Council District. The council member, who is always busy advocating for, fighting for, and serving New Yorkers, Brooklynites, and specifically those in her district, was not able to join us herself tonight, but we are happy and pleased to welcome Andrew Wright, who is her Senior Director of Policy and Budget Initiatives. Andrew, thank you so much for joining us. We appreciate you being here on behalf of the council member. We know how busy you guys are, so we do truly appreciate you taking the time to join us on the call. And without further ado, the floor is yours to share any thoughts, words, insights, anything with the community.
Thanks, Ariana. Deeply appreciate that. First off, I definitely want to apologize for the council member. She couldn't be here today. She's currently at a community board meeting, trying to advocate and learn from folks about their needs around the district. As Ariana mentioned, Councilmember Hudson represents the 35th Councilmanic District, which includes the neighborhoods of Fort Greene, Clinton Hill, Prospect Heights, Crown Heights, and a little bit of Bed-Stuy. And so many folks on this call may be our constituents. And so before I close out, I'll make sure to put our contact info in the chat so y'all have it if you need help with anything at all, housing, a bill, a water issue, flooding, you name it, we can do our best to help you and connect you with the proper resources. For those who aren't familiar with Crystal, so she got into public service because of her experience working with government when her mother was diagnosed with Alzheimer's disease. She tried to get so many benefits and apply for various programs, but found it incredibly difficult to break through or to find the right person or to really understand how these systems worked. And so her goal ended up becoming how to make government more accessible for more people. And so she moved from a very successful career in sports marketing. She worked for the WNBA, she worked for Amtrak for a while, into public service to work for the city. So she worked in the city council for a while. She worked for the New York City Public Advocate for a while. And then in 2021, she was elected to her first term representing the 35th Council District. And she's also a lifelong Brooklynite, born and raised here, and currently lives in Prospect Heights as well. So she knows the neighborhood, she knows everyone. You've probably seen her on the street, and if you haven't, you will very shortly. And so I think, part of why we're super excited about Grow Brooklyn and BKA's, work here is because, as Ariana mentioned, taxes can be incredibly difficult to understand, to wrap our heads around, because sometimes it feels like it's made that way. It feels like, why do we have all these forms we have to fill out? Why, do I get all these forms in the mail? What do they mean? What are deductions? What is my adjusted gross income? All of these things, there are a lot of terminology. And for many of us, we didn't learn about this in school. There may not have been some sort of financial literacy course or tax literacy course, when you were in school. And so it's now up to us, now that we have to file our taxes, to figure out what's what and to learn from the experts to ensure that, we get the strongest return possible while also complying with the various complexities of the tax code. And so I'm, the council member and our team are really grateful for this work because we believe that, BK and Grow Brooklyn are really making government vis-a-vis the IRS more accessible for more people. And so that hopefully by the end of tonight's session and then the third session, you all have a better sense of, what the tax code includes, what are various deductions, and just know the terminology and know where to turn for more resources. And so with that, I'll turn it back to Ariana. But as I mentioned, if y'all want any help with anything relating to the city, federal or state governments, don't hesitate to reach out to our office. Our phone number is 718-260-9191. I'll put this in the chat for folks. And our email address is district35@council.nyc.gov. So thanks so much, and back to you, Ariana.
Thank you so much, Andrew. Yes, guys, feel free to use that information that he's going to put in the chat. Your council people are your advocates. They're there for you. They're there to help you, as well as, nonprofits and community organizations such as ourselves and such as BKA. So please always know to take advantage of these services and any help that the community is giving amplification to within, our inner community circles. Thank you again, Andrew. Thank you to your office, your team, as well as the council member. We greatly appreciate you all. So with that, I do want to also acknowledge, as we make our way closer to the beginning of the presentation, I promise, guys, we're almost there. I want to acknowledge our speakers. We have the pleasure of welcoming Rajan from Grow Brooklyn, as well as welcoming Rajan, who's going to be talking about tax credits and deductions, as well as welcoming Charles Healy from BK Legal, who's going to be discussing important information for targeted abuse clients who are claiming dependence. So yeah, we're about to get started, but we are going to give a little bit more space to just letting you guys know about the different services that Grow Brooklyn offers, as well as the different services that BK Legal offers, so that you are able to take advantage of those services as well as our tax services. So yeah, Grow Brooklyn is a Brooklyn-based nonprofit that serves all New York City residents, despite our name being Grow Brooklyn. And our mission is to enable individuals and their families to grow and protect their assets in order to secure their economic futures. And we fulfill this mission, or live up to this mission, by providing free tax prep, pro bono, and low-cost legal services, as well as financial and housing counseling. Our foreclosure prevention program offers free counseling to help our community members hold on to their homes if they're facing foreclosure. So we have attorneys who can represent you at settlement conferences, as well as negotiate a resolution, and counselors who are willing to negotiate for you, talk to your lenders, and give you budgeting and documentation advice. Our Protect Your Treasure program, or as we affectionately call it, our PYT program for short, offers pro bono end-of-life estate planning legal services. And this includes assistance with surrogates court, as well as the preparation and execution of estate planning legal documents like living will, healthcare proxy, last will and testament, power of attorney, and other advanced directives. And this year, Go Brooklyn is very proud to be one of 5 partners on the Center for New York City Neighborhoods Black Homeownership Project, Generation to Generation Estate Planning. Quite the mouthful. But through this program, we're offering our free estate planning services for Black homeowners who are located in Central Brooklyn, South Brooklyn, and the North Bronx, as a way to ensure that Black homeowners in our city are able to keep their homes, pass them down to their families, and create generational wealth, which leads to wealth equity, which leads to better opportunities and better services and just a better overall, state of living in our city. Additionally, as a HUD certified organization, our financial capabilities program offers free one-on-one financial counseling for anyone, but specifically for homeowners who are looking to work towards specific homeowning goals, like creating a sustainable budget, repairing and building your credit history, establishing a savings, and so forth, over time to prepare individuals and families to be able to navigate the home buying process. And finally, our free tax prep program, which is run through the IRS's Volunteer Income Tax Assistance Program, or VITA for short, and the New York City Department of Consumer and Worker Protection's free tax prep program. Basically, through this program, we are able to help people book an appointment. Once you book your appointment at one of our tax sites, you have your return prepared, reviewed, and filed by an IRS certified volunteer tax preparer. On our first day of appointments, we're really, really proud to say that we prepared 29 returns, which translated to roughly $100,000 in refunds delivered back into the community, and $7,500 in tax prep fees that you would normally pay to a for-profit agency or a for-profit service. But with saving that money, that's money that goes towards things like rent, groceries, bills, school supplies, essential clothing to gear up for the winter months, things like that. So we're here, we're ready to offer our services to the community members, and all of our contact info will be up at the end in order for you to get in touch, make an appointment, or even seek out more information. But with that, I'm going to pass it over to Charles to talk a little bit about the services that BK Legal provides.
Hi, good evening. First, I want to thank Councilmember Crystal Hudson for sponsoring the event, and Andrew Wright from her office. Also, Grow Brooklyn for sponsoring, and Rajan, who will be speaking tonight as well. So thank everyone for putting this together. My name's Charles Healy. I'm a staff attorney with Brooklyn Legal Services Corporation A. Brooklyn A was founded more than 50 years ago, and we now serve clients throughout all 5 of the New York City boroughs, from our offices in Williamsburg and in Bed-Stuy. We provide innovative, collaborative, neighborhood-based representation and advocacy that advances social and economic justice and opportunity. The core theme of our high-quality, low-barrier legal services is to support individuals, families, and small businesses so they can thrive and stay rooted in their communities and neighborhoods, despite the pressures of gentrification and displacement. We have 3 main program areas: preserving affordable housing, which focuses on eviction prevention, anti-harassment, specifically within a landlord and lease situation, repair and essential services cases, and tenant organizing. We also have a community and economic development program, which focuses on commercial lease assistance for small businesses and nonprofits. That unit negotiates rent and arrears and nonprofit incorporation and startup services. I'm part of the Consumer and Economic Advocacy Unit. What we do there is we have a low-income taxpayer clinic, which offers a variety of tax resources. We have a foreclosure prevention unit within this Consumer and Economic Advocacy Unit, where we look at, for instance, cases of deed theft, predatory lending. We also do a lot of work in the Queens County and Kings County courts, assisting homeowners in foreclosure. So we provide legal services to individuals who are facing a foreclosure lawsuit. That the unit I'm in has also just started up a domestic violence program, which offers a variety of services, including assistance with orders of protection, child custody, support, and other services too. So if you have any questions about what we do, we have a great website, www.bka.org. You can also contact us at 718-487-2300 or write an email to info@bka.org.
Thank you so much, Charles. So with that, it looks like we're about ready to get started and hop into our presentation. So I'm going to pass it over to Rajan, who's going to kick it off talking about tax credits and deductions, which will then lead into the discussion about more information, important information, for targeted abuse clients who are claiming dependents. And then we will open the floor up to questions. So Rajan, I'll pass it over to you.
Okay, my name is Rajan. I work with Makila doing free taxis for lower and medium income people. We are spread about all over Brooklyn, a couple of sites in Queens and Bronx, but we give free services to people who cannot afford to go to a paid preparer. And after 2 difficult years of pandemic where we had to do remote mostly, I'm very happy that this year we can do in person. So we will be able to face-to-face with the taxpayer and do in person and save them money and get them the best refund they can get. Let me go into the details. A tax deduction is a dollar amount that the IRS allows taxpayer to subtract from the adjusted gross income, what is AGI, to lower the taxable income. Now, the total income that you enter, which is your wages and salaries and interest and dividends and capital gains and rent and pension income and whatever other income you have, which makes up the total income. From that, you're allowed to deduct certain items to come to the adjusted gross income. And certain items that you can deduct as adjusted gross income are something like an educator expenses. If you're a teacher, you can get about $300 of deduction as an adjustment. If you have a heavy health savings account and you put money away in a health savings account, you can deduct that. You can deduct money that you contribute to the IRA, student loan interest payments. So there are certain things that you can deduct from your total income to come to what we call the adjusted gross income. And that AGI is very important because a lot of other deductions and other credits depend on the AGI. So that's the important thing to know. It's the last line on your 1040 page 1. And then we can go to the next slide. Okay, once you come to your AGI, which is your total income minus deductions, then you're allowed, that becomes your taxable income. And then you're allowed to deduct either a standard deduction or an itemized deduction. A standard deduction for most taxpayers is a set dollar amount based on the taxpayer's filing status and his age. An increased standard deduction is available to taxpayers who are 65 or older or blind. If you're a dependent on somebody else, you can still take a standard deduction, but not the normal standard deduction. There's a worksheet to work out your standard deduction, which will be much lesser than the regular standard deduction for a taxpayer. Taxpayers not eligible for standard deduction, married file separate if the other spouse also itemizes. The itemized deductions are something that your mortgage interest, property taxes, and medical expenses and all that. And if one spouse decides to itemize because his itemization is more than the standard deduction that he would get, then if you finally file separately, the other spouse has to also itemize, even though she may not have enough deductions. There is a case where if a spouse has lived apart from the the other spouse for 6 months of 2022 and has a dependent, she may qualify as head of household. And if she qualifies as head of household, then she may be able to claim the standard deduction, even though the other spouse is married may file separately and itemize. In 2022, those who took standard deduction may not be allowed to take the charitable donation, which was allowed, I think it's about $300 that they were allowed in 2020 and 2022. Well, that is gone now. So the only way you can take a deduction of charitable donations would be if you itemize. Otherwise, there's no more line 12B under the standard deduction. Next slide. Okay, these are the standard deduction amounts for depending on your filing status and your age, and they can go from $12,950 up to $28,700 for both, or married file jointly if both spouses are over 65. So that's a large amount, and because of this big numbers that you have on standard deduction, most of the people do not itemize, they just go for standard deduction. So these are the numbers for standard deduction, very important numbers. Next slide. Now, as I said, some people may want to itemize because they have a lot of expenses that will be over and above the standard deduction. For example, you have unreimbursed medical and dental expenses, including prescription drugs, health insurance premiums, including the premium that you paid out of your Social Security income, transportation, going to the doctor or the dentist, long-term care premiums for spouse and the taxpayer and the dependent. And you add up all your medical expenses, and then they have to exceed 7.5% of the AGI. As I mentioned, AGI is a very important number. And you have to exceed 7.5% of your AGI to take it to an itemized deduction. State and local taxes and real estate taxes, if you own real estate, you can take these as itemized deduction, but unfortunately you're limited to a $10,000 limit. I know people living in Long Island who pay a lot of real estate taxes on properties. Some pay as much as $30,000, $35,000 on real estate property that they own, but you're only allowed to take $10,000. And the state and local taxes will be from your W-2 or whatever. So you can take all those, but limit it to 10,000. Also, if you own property, you can take mortgage interest. You have to wait for the mortgage company to send you a 1098, and they'll give you the amount of the mortgage interest and also the real estate interest that you have. Home equity loan interest paid is deductible if the loan was used to buy, build, or make a substantial improvement on the residence. You can take that as a deduction. Next slide. Points. Now, some mortgage company will insist on you pay points when you apply for the mortgage, and if you took generally points may be spread over the life of the mortgage, which could be 15 years to 30 years. However, if the loan is used to buy or build the taxpayer's main home, the taxpayer may be able to deduct the entire amount in the year paid, and that could be a substantial deduction. The next deduction on itemized is gifts to charity in kind or in cash. And what we ask the taxpayer who come to us, that they must have some backup documents for the charitable donations they have made. The name of the charity, the donation they made, the date of the donation, or if they donated in kind, if they gave out furniture or used clothing or whatever, they can take it, but they must have some kind of proof to back up the charity donations. Gambling losses to the extent of winnings can be deducted from the item as an itemized deduction, and casualty and theft losses from a federally disaster area. And as you know, we had a lot of floods in California, and there's some weather problems in Dallas, Texas. And if the federal government declares a disaster area and you lost through casualty or theft losses, you can take a deduction as itemized deduction. Next. Now, both the standard deduction and the itemized deduction lowers the amount of taxes you owe. So you can choose one or the other. And then you will calculate your taxes, what the tax is going to be. Now, after you calculate your tax, there are further deductions that you can take. And there are refundable credits and non-refundable credits. Refundable credit it can also give you a refund when you owe no taxes at all. So you can get money back even if you have a zero tax liability. Some taxpayers may find non-refundable credits, deductions, or other circumstances leave them with a zero tax due. Even if no tax is due, the taxpayers can still apply for a refundable credit they qualify for and receive the amount of the refund. For example, if a taxpayer ends up with no taxes due and he qualifies for $2,000 refundable credit, he would get the $2,000. So these refundable credits are very useful even if we have zero taxes to pay. And the these refundable credits are based again on your filing status, how many dependents you have, and all that. Next slide. Refundable tax credits are called refundable because if you qualify for a refundable credit and the amount of the credit is larger than the tax you owe, you will receive the refund, the difference. Next slide. For example, if you owe $800 in taxes and you qualify $1,000 refundable credit, and we'll go through different refundable credits later on, but if you qualify a $1,000 refundable credit, you'll end up getting $200 refund. Now, what are these tax credits that we talk about? These credits come after you calculated your taxes due. Then you tax refundable or non-refundable credits. Credits can be earned income tax credit, and this is a very important tax credit. We make sure everybody who is qualified for it gets it. It can amount to a lot of dollars, and it is refundable. The other one is child tax credit. If you have dependents and you have children under the age of 13, you get child tax credit, and there's also an additional child tax credit, which can be refundable. There's also child independent care credit. If you have a nanny or somebody to come home and look after your children while you work or while you're looking for work, and you pay the nanny or whoever takes care of the children, you can take child independent care credit. In 2020 and 2021, because of the pandemic, we were allowed to take part of the child independent care credit as a refundable credit, but that's gone now. You're in 2022. So the child independent care credit is not a refundable credit. You can only use that to reduce your taxes due. The next one is education credits, and American Opportunity Credit and continuing education credit. And some of these are refundable. We'll go through the details a little later on. All tax credits come with a set of qualifications that the taxpayer needs to meet in order to receive the credit. Some common requirements include an income level with certain range, and which means that if you're making six-figure income or more, you probably may not qualify for this. This is meant for lower income people So the income has to be within a certain range. It has to be on the family size. If you have one dependent or two dependent or even three dependents, you can get much more. And a requirement that taxpayer has earned income. Now, that requirement, taxpayer has to earn income, because if you see the top line, earned income tax credit, it says earned income tax credit. You have to have earned income. It cannot be dividends and interest, capital gains and pension income and rental income. These are not earned income. Earned income is coming from work. You have to be working to earn income, and then you qualify for earned income tax credit. Next one. Tax credit reduces your actual tax liability. Earned income is a refundable credit designed to help low and middle income households. To qualify for this credit in 2022, a single filer with no children must have an AGI, again we talk about AGI, below 16,480, while the cap for a married couple with 3 or more children can go up to an income of 59,187 to qualify for earned income credit. Anything above that, anybody earning above that will not qualify for earned income credit. Next one. Again, this is a refundable credit and designed to help out low and middle income households. To qualify for, we already went over this, to qualify for this income, your income has to be single, under 1640, 1680, or married with 3 dependents under 59,187. You cannot claim on income tax credit if you have investment income over 10,300, or if you married file separately. So your investment income, which includes dividends, interest, capital gains, pension income, rental income, all these what we call passive incomes. If you have these incomes that are come to more than $10,300, then you don't qualify for an income tax credit. And if you're filing separately, you don't qualify for an income tax credit. Depending on your income, your filing status, and number of dependents, credit can save you anywhere from a few hundred to a few $1,000s in your taxes. And remember, it's a refundable credit. The earned income tax credit is an important benefit for working people with low and moderate income, but you must file a federal return to get the income, even if you have no income tax. Some people make very little income. They had a job and they lost the job and they only had small income, which is under the standard deduction, so they have no tax to do. But if they are working, if they're earning, then they're entitled to earned income tax credit. So you still should file, even if you have very low income, because you qualify for earned income tax credit. Next slide. Now, these are the limits for qualifying for earned income. Zero meaning single, your limit is 16,480, or married file jointly, 22,610. If you have one dependent, it goes up to 43,492 or 49,622. These are the limits for the income to get the earned income. If you have 3 dependents, 49,399 or 55,529. And if you have 3 or more dependents, you can earn up to 53,057 or 59,187 to qualify for earned income credit. Next slide. Now, you can see the earned income tax credit can amount to quite a bit of refundable credit. It can go from $560 for a single with no dependents to $6,935 refundable credit for anybody with 3 or more dependents. So you can see that the earned income tax credit refundable is quite a few, is a big benefit to people with low income. It supplements their wages and helps to support the family. Next slide. Now, tax advice to people who, why they should file. About 1 out of 5 eligible taxpayers either don't file some credits on their returns or don't file a return at all. Even if the individuals are not required to file a return, you should file a return if you qualify for certain credits. For example, you have earned income, you worked, you qualify for earned income tax credit, although your income is too little to claim to pay any taxes, you still qualify for a refundable credit. So you should file, even if you only made $2,000 in the year, so long as it's earned income. To get additional child tax credit or American Opportunity Credit, you should file, even if the income is less. Of course, if you have W-2 and you had taxes withheld from your employer, you should file, even if it's less, because those taxes will come back to you. And if you have what we call the marketplace insurance, if you bought marketplace insurance and you get a 1095A from the marketplace, you have to enter that to see if you got a premium tax credit, or you may have to pay because you got too much credit based on your income. Because what happens is that when you apply for the marketplace insurance, you have to apply the year before, and you have to estimate your income for the year that's going to be coming. And based on your income and your filing status and all that, the marketplace will then quote the premium and quote how much credit you will get, which they will pay to reduce your premium. If your income goes up than what you estimated, or it goes down, you may get extra credit, or you may have to pay back some other credits. So in that cases, you have to file. And if no federal return is required, and talking about New York, if no federal income is required, you still benefit from this filing a state return, because New York State will give you, if you live in the 5 boroughs of New York City, New York State will give you a school credit, $63 for single and $125 for married. They'll give you property credit if you pay rent or you pay property taxes. You may qualify for some. So even if you don't file federal because you had no income on federal, you should file state return if you had no income at all, just to get those credits because you live within the 5 boroughs of the New York City. I don't know about the other states, but I'm only talking New York as far as I know. Next slide. Child tax credit. If you have a child under the age of 17, you can get credit, and is your dependent, you can get credit up to $2,000. But of course, there's a limit of income. If you make too much money, $400,000 or $200,000 if you're single, you won't qualify. But all of our clients who are medium and low income people qualify for the child tax credit. So we make sure that they get it. And child tax credit can be partially refundable up to $1,500. Next slide. Child tax credit is a non-refundable credit for the tax year 2022. Families claiming child tax credit will receive up to $2,000 per qualifying child. To be eligible for that, the child has to be under the age of 17 as of December of the tax year, has to be a US citizen or resident, has to be dependent on the taxpayer, has to be a child, sibling, or descendant of other. There has to be a relationship. And he or she provides less than 50% of their own support. The taxpayer provides most of the support. Lives with the taxpayer for more than half the year, must have a social security number. And there are special rules for divorced and separated parents, which are detailed, so we won't get into that now. But if anybody has questions, I can answer that. You can claim credit even if you work from home. And this is called Child Independent Care Credit. This is a non-refundable credit, so it reduces your taxes to make it go to zero if possible. You can claim this credit even if you work from home and pay someone to take care of your child. You must have the care provider's name, address, and social security number. If the taxpayer tries to obtain this and could not get it, then you can still file and claim the credit, but you won't be able to electronically file the return. The taxpayer will have to mail the return. The credit ranges from 20% to 35% of the taxpayer's expenses. The percentage is based on the taxpayer's earned income and the AGI. The amount of the credit cannot be more than the amount of the income tax on the return, which means it's non-refundable. It can reduce your liability to zero, but you cannot get a refund for child independent care credit. Now, just to remind you, in 2020 and 2021, because of the pandemic, part of the child independent care credit was refundable. But we're now in 2022, and that is gone. Payment to relatives may qualify as work-related expenses so long as you don't claim that relative as your dependent. So your mother, who lives separately from you and you don't claim her as dependent, comes to take care of the children while you work or while you work or while you're working from home, and you pay her, that can be claimed as a dependent child credit. But it's not allowed for if the taxpayer's child is under the age of 19 at the end of the year and takes care of the little children. That does not work. Next slide. Now, these are education credits. If you are a college student, a student's parent, graduate with a student loan debt, or employee seeking further education, you may qualify for these credits. Now, the first credit is American Opportunity Credit. The American Opportunity Credit is allowed for the first 4 years of your undergrad study, and it can pay up to $2,500 for qualified expenses for each qualifying child, and up to $1,000 may be refundable, depending on the amount that you pay. But you have to have, it has to be for the first years of undergraduate study. You cannot do that for graduate studies. The lifetime learning credit is up to $2,000, non-refundable per student. And if you're taking classes to improve your skills at work or to learn something that you want to learn so you can get a better job, regardless of your age, you can get a lifetime learning credit, and it can be up to $2,000, but it's non-refundable. Student loan interest is deductible up to $2,500. It can reduce your taxable income, and it's part of the deduction that you can take is coming down to AGI from your total income. Next slide. Now, the 529 plan, and again, I'm only talking about New York because I know New York, not all the states allow you to do a 529, but fortunately, New York allows you to take a 529 plan. Basically, what it is, it's not affecting your federal income, not affecting your federal taxes, but on the New York State allows you to open a 529 account to save money for college for your kids. So if your kids are ambitious and want to go to college and you want them to go to college, you can open a 529 account. You can choose where you want to open it. It's called a 529 account. And you can deduct up to $10,000 from your state taxes, up to $10,000. If you have 2 children, both aiming to go to college, you can take $5,000 each, open 2 different accounts and put money there. And it is deductible from your New York State taxes. However, the money that you have in the 529 account can only be used for college education. You can't use it for anything else. You can't do it out and buy a car or something like that. It has to be for college education. So the entire amount can be used for accredited college. When the state tuition is paid up in front, initially this type of plan was set up for a particular college or university in mind. And you can save money. You can choose the bank or where you want to do and just go to the bank and say, I want to open a 529 account, and you put money there every year, and it will help you pay for the college education. So I would definitely advise people to do that. It saves you on your state taxes. But not all states have that. New York does have. Cloverdale Education Savings Account, you can set aside $2,000 per year for the beneficiary, and it can be used tax-free, not only for college, but for kindergarten to 12 expenses as well. The student beneficiary must be under the age of 18 when the account is created. There are some limitations. Usually the financial institutions where the account is located, there should be a custodian, and a Cloverdale ESA account is considered is considered a parent's asset by the financial aid system, just like the 529 account. But it's unlikely that you'll get any state break for that. But again, I would advise, if you can save, I would advise definitely to go for 529 plan. Next one. Okay, the dates to remember for filing the taxes. This year you have it until Tuesday, April 18th, because Monday is a holiday. That's because April 15th is a Saturday and the April 17th is a holiday in DC. So the deadline is April 18th. When is the deadline for filing extensions? If you file an extension because you don't have all the paperwork with you already, or maybe you're traveling or you don't have time, you file an extension. And the extension will give you until October 16th, 2023. But remember one thing, if your experience tells you that in the past years you had to pay taxes because you're self-employed and you're paying not only taxes, but you're also paying Social Security and Medicare for both the employer and employee because you're your own boss, and you end up every year having to pay, then I would advise that even if you file extension, pay the taxes in time before the April 18th date, because the extension is only for the paperwork. It's not extension to pay. You cannot get extension until October 16th to pay the taxes. If you don't pay in time, you will be subject to penalty and interest. So the extension gives you only time to complete your return and do the paperwork, but not to pay. Next one. Okay. Identity theft has become a big problem for the IRS. It's increasing, and a lot of people go into it. Unfortunately, it's a fact of life. Now, when you want to talk to the IRS, when you want to send something get something from the IRS, for example, you want to know what's happening to your return. You e-filed it and you didn't get the refund. A month has gone by and you want to know what's happening. You can go to the IRS website and look at what's the situation about my taxes. Or you want to go see what's my refund. Or you want to see if there's you want to get a transcript of your past taxes. Anything you need, you go to the IRS website and you can get that. But before you get into your own personal information, you have to identify yourself. And it used to authenticate your identity. It could be your social security number, your passwords, your IDs, your credit card, debit card numbers, your date of birth, prior year's AGI. You have to have this information to be able to get into the IRS website to get more information about where tax is happening. You can never be too careful in protecting the personal information. Make sure the website that you share have security measures in place, like a two-step verification and encrypted certificates. Phishing, a tactical used by scammers to get your personal identification online. They can use email, and I get a lot of these. I'm sure you do. You get an email or website saying the IRS requires you to pay such and such, or the IRS needs more information about you. I would say that if you see any of these emails, ignore them. Any email asking for your tax information, your social security numbers, or anything else, ignore them. Any threats saying that you have to pay unless you pay, we're going to send the police, ignore them. These are scammers that are trying to get into your information. So please, ignore them. Only if the IRS will not contact you on social media or on email. IRS will not contact you by phone. The only way the IRS will contact you if they want more information is they will send you a letter through the usual post. If you get a letter in the usual mail from the IRS, then you know it is genuine and you can respond to that either by going to the website, calling them. But other than that, IRS will not call you or send you a social media or an email you. So please ignore those. Next slide. Okay, I think I'm done. Ariana?
Hi, yes, thank you so much, Rajan. That was a great presentation. That was the first part of our presentation, and now we're going to move into information for targets of abuse who are claiming dependence, and Charles will be presenting that part. So I'll pass it over to you, Charles.
Okay, thank you very much. And thank you, Rajan. That was a lot of great information. I'm actually going to build on or echo some of what Rajan has said, because it is all tied into the next topic, which is targets of abuse who are claiming dependence. So when I say targets of abuse, what I'm referring to is someone who's in an abusive relationship. For instance, someone who's a survivor of domestic violence. So what I'm going to cover tonight are dependents defined. So if you are a victim of domestic violence, it's important to know, and you're trying to claim a dependent, it's important to know what a dependent is. I'll also talk about how dependents affect your credits. And Rajan did a great job covering a lot of the credits that a lot of people will be claiming. I'm also going to mention identity theft, because that is something very relevant to people who are targets of abuse. There's a special rule. It's called, well, a group of rules. They're called the tiebreaker rules. So I'll explain what those are. And I'll give some additional tips for domestic violence victims and some resources that they could turn to if they feel like they would need to do that or want to do that. And following that, we'll take questions. So starting off with dependents and what they are. As Rajan was saying, dependents are a big factor in your tax return, and the presence of a dependent on your return can make a significant difference in the refundable credits or the not even non-refundable credits that you get. So what exactly is a dependent? First of all, it is a two-step process in determining how if someone is a dependent. First, you have to determine if they are either a qualifying child or a qualifying relative, and then you'll determine whether or not, if they do meet that test, that they are actually a dependent, because that's an extra step. So there are some very particular rules on these, and I'll talk about them, but you would want to make sure to consult your tax preparer, or if you're filing yourself, you can even consult some of the IRS publications, including 501. So a qualifying child is somebody who, basically there's a few different factors that determine whether they're a qualifying child. So those factors would be the age of the child, the relationship between you and the child, the residency of the child, basically where that child lives, and even whether or not the child is filing a joint return, because they could be an older child or technically an adult and filing a joint return with their spouse. So if that's happening, there's some special rules on that to pay attention to. With regard to their age, though, there's a few different ways you can be a qualifying child. You can be any age and disabled. You can be under 19 at the end of the year. So that means you basically you can be 18 at the end of the year and still be considered a child. And under 24 at the end of the year if you're a full-time student. as far as the relationship goes, it's for biological children. It's also can be for siblings, grandchildren, and adopted children. And so you want to make sure that you are just looking at the rules, because even folks that you think might not qualify as your dependent, they could in fact qualify, or at least for qualifying child status. The other thing I want to start talking about now, and I'll hope to be working this, weaving this subject through the rest of the presentation, is the concept of documentation. So when we have a victim of abuse, often it's hard for them to retain documentation, but it's important that they try to do that, because they could be called upon down the line to prove that the person in question, the child, for instance, is actually a qualifying child. So what they would need to do sometimes is prove their relationship or prove the age of the child, prove the residence of the child, that the child lived with the taxpayer. Those are all important things to maintain records on, and I'll talk more about how you can do that over the course of this presentation. So qualifying child is the first step, or qualifying relative. Just to touch on the qualifying relative, that could also be a biological child or an immediate relative, even your father or mother, stepbrother, stepsister, but there's some other rules that apply. And
I'm on a seminar, can I call?
So basically, the qualifying relative would be, there's other tests that go into determining if it's a qualifying relative. The relationship to you, their residence, if they lived with you all year, and if they're not, if they're not a qualifying child, they can't be both a qualifying child and a qualifying relative. If they had income of less than 4,400. So there are a lot of little details that go into determining these statuses, and it's important to be familiar with some of the major ways they're determined, and start thinking about documentation in case you do end up having to prove that they meet those relationship tests. Finally, to take the next step to determine whether or not they're going to be a dependent, you will be focusing on their residency status. Are they a United States citizen, U.S. national, U.S. resident alien, resident of Canada or Mexico? Are they married or not? That's an important factor. And if you yourself as a taxpayer are not claimed as a dependent somewhere. So these rules it's a lot to memorize, and I wouldn't even really encourage memorization of them, because it's more important to look at the rules themselves, or to consult a professional who is very familiar with them. But the idea here is there are things that you may be called upon to prove down the line, and I'll start to talk about why that might be the case. So we can go to the next slide. So for dependents and credits, if you're trying to claim certain credits, your dependents will be a factor in whether or not you're actually be able to claim those. For the earned income credit, you actually don't need to have a child, but if you can claim head of household status, which Rajan was talking about before, that could reduce your AGI, and therefore you might then be eligible. That might be a determining factor, for instance, to if you're eligible for the earned income credit. So that's how a dependent would relate to that. There's also the big credits that folks are going to be trying to or wanting to claim are the child tax credit and credit for other dependents, dependent care credit, which is related to expenses that you paid for your child. And you might also be wanting to claim credits for previous years, which are the additional child tax credit, advanced tax credit, and the economic impact payments. So a lot of these will depend on whether your child or the person in question can be claimed as a dependent on your tax return. And I'm gonna mention why that's important. Basically, is because if you need to prove, like I've been saying, you have to be careful about your documentation and maintain that. So let's go to the next slide. Okay, so the actually, there's something I want to mention on the slide before that I didn't mention yet. So another thing about these credits is, actually, it can go on the next slide. I'm sorry. Okay, so an important thing to consider is identity theft. As Rajan was saying, it's something that does affect a lot of taxpayers. If you're a victim of abuse, it could potentially be even more likely to affect you. The important thing to think about here is when we're talking about dependents, there are people who are in a relationship with, or they are exiting a relationship with an abusive spouse. That spouse may attempt to claim a child on the tax return and thereby attempt to entitle themselves or make a claim for a stronger standard deduction, a higher standard deduction, and the credits that would go with that dependent. So it's important to be aware of that. That's another reason why you want to make sure you're keeping documentation, because if you are entitled to claim the dependents on your return, you want to have as much evidence as possible to dispute a fraudulent return like the one I just mentioned, if someone does something like that. These other tools that are listed on this slide here, the identity theft affidavit, if you feel as though you've been a victim of identity theft and it's related to your taxes and that's how you found out, it's a great idea to submit with your tax return or even independently an identity theft affidavit explaining your situation. And that will trigger a investigation into the returns in question and your account with the IRS to find out if any fraudulent activity has been happening. If someone, for instance, has been claiming your dependents on their return, even if they're not entitled to do so. The identity protection pin is another thing. You can get that through the online portal. You have to pass through a verification process for that. You can also set up a taxpayer assistance center appointment, and that's one of the quickest ways to get them for your children. The annual credit report is something that we mentioned where you can get 3 of them for free each year. And if you're a victim of abuse, you might be someone who someone has opened accounts in your name to try to either manipulate you or to cause you financial harm, or simply attempt to have gains at your expense. So the annual credit report will show you all the accounts that have been opened in your name using your information, including your social security number. So we can go to the next slide. Okay, so one of the big subjects in this talk here is what came up with the example of someone improperly claiming a dependent on a tax return. And, or at least if it's not 100% improper, if there's a dispute between the two taxpayers, there are rules to determine who will actually prevail in claiming the dependent or the qualifying child. So first of all, there are situations where a parent will try to claim and a non-parent will also try to claim. In that situation, the parent will take priority. When two parents claim on separate returns, it will be the parent who the child lived with for the longest. If they live with them for an equal number of days, and so that's who lived with them the longest in the during the course of the tax year in question. If the time was equal, then it would be the parent with the higher adjusted gross income. That is who would actually be able to claim the qualifying child on their tax return. When neither parent can claim the dependent, when neither parent, but when a taxpayer who properly can claim a dependent, but who's not a parent of the dependent, when that situation occurs, and there's multiple filers, for instance, the person with the highest AGI would win on that. Finally, when a parent can claim the the dependent, but they do not do so, the person with the highest adjusted gross income would be able to claim, but only if that's higher than the adjusted gross income of the parent. So the rules on these are, they go through twists and turns. They're very specific. It's just another reason, I mean, if not one of the primary reasons for speaking with a tax professional when you're preparing your returns or when you're dealing with issues on previous returns. So we can go to the next slide. Okay, so when we're talking about the most important tips or some of the big tips that we want to give to victims of abuse and domestic violence who are trying to claim their dependents, we talked about some of the identity theft issues that can occur. One way, there are the identity theft affidavits and the identity protection pins. Those are very great tools to use, but another thing you can do is just simply file as soon as possible. If your return is filed ahead of somebody else's, that's basically a great way to get priority on the refund and the ability to properly claim that dependent and not have to worry about someone else jumping ahead of you and doing it improperly. And we were talking a lot about retaining documents. So I think many people who are attending have heard this a lot, to always keep documents for your income during the year. When you're a victim of domestic violence, that can be difficult. So we have some additional tips for you on the next slide also, but if there's a trusted friend that you have, or even a social worker, or even an attorney, you can ask them to make electronic copies for you and store it in their file, so you have a backup in case you need it. But retaining your documents to prove what's on your return is really important. When you're trying to prove your dependent's residence, there are some ways you can do that that are very effective. First is, so the reason I bring this up is because where your dependent lived during the course of the year will be a factor as to, your ability to claim them. But some of the ways you can do that are through a lease agreement. So if your dependents are listed as occupants on the lease to your apartment or residence, that's great proof. Also, if you have some kind of a custody order from a court, that will be very good proof, as well as school records, which would show the district they live in and might have other indicators of where the child is actually residing. So we can go to the next slide. So like we were saying before, electronic records, very important, if you can. So I know it's difficult, especially if you're a victim of domestic violence, you might be moving from house to house, apartment to apartment, or shelter to shelter. And it's difficult to bring everything with you sometimes, or you may never have had a chance to gather your documents before exiting your previous residence. That being the case, it's always good to try the best you can to scan documents into a computer. So if you can do that with a social worker or a trusted friend or relative, that's great, because if you lose the hard copies, you have those backups that you can use later if you need to. You can also obviously take photos with your phone if you have a phone that it has the ability to take photos. And another thing that I want to make sure to mention here is when you're out getting your tax return prepared, whether it's through a professional preparer or if you're doing it yourself, you want to make sure that you review your return before it's actually submitted. You also want to get a confirmation that it was submitted. So if it's electronically filed, you should get the preparer should get a confirmation. You want to make sure that you get a copy of that too. But before it ever goes to the IRS, you want to make sure that it has the proper information on there. You may not be able to scrutinize the schedules and the dollar amounts, that might be difficult, especially the calculations, but take a quick look and see if they look generally correct. And also the names of you and your children or the other people that are on the tax return, make sure those names are spelled correct, and make sure the their social security numbers or ITIN numbers, if those are on there, or ATIN are accurate. Finally, if you are a victim of domestic violence and you had a joint account with somebody who's been abusive to you, you would be encouraged to open up a separate bank account with your own name on it, so that when you file your tax return, you can use that account information and have any refund sent directly to you. And then you're not going to have to worry about the other person quickly withdrawing the money from the account and you not having access to it. The electronic deposits are great. I would say better than receiving a refund in the mail, just because it's quicker and it's easier to trace if there's ever an issue. Finally, some resources. On the next slide, we have resources for victims of domestic violence at Brooklyn Legal Services Corporation A, where I'm a staff attorney, which is also abbreviated as BKA. We have a domestic violence clinic. We also have a low-income taxpayer clinic for folks who are fighting, who have an IRS issue that needs to be resolved. And you could also go to a VITA clinic or Grow Brooklyn to have your taxes prepared by someone at basically no cost. So thank you very much for coming tonight, and it's been a pleasure to talk with you about these important issues.
Thank you so much, Charles. That was such a great presentation and a great way to make our way back around to centering the community, centering you guys. We want to open it up to questions, but before we get to that, I understand some people sometimes don't want to stick around for questions, but we still want to make sure that you're able to get the information that you need. So up here, if you would like, if you do not plan on sticking around for the Q&A, I do advise, taking a screenshot, taking a picture, because we're going to move away from this slide and then circle back to it after the Q&A. But yeah, for those of you who don't want to stick around for the Q&A, this is the contact info for BKA. They have two different locations that you could visit. I do want to make the disclaimer for the Grow Brooklyn location that is listed. We do not accept walk-in appointments at this location or at any of our tax sites. But if you go to the website, you can book an appointment there. If you don't have internet access, you could make a phone call, or you could come by and have an appointment set up for you, but you will not actually be able to like have your documentation and your tax return prepared at the site. You could also send an email or call, but yeah. And also this is the flyer. Once again, if you would like to take a screenshot of this before we circle back to the Q&A, part 3, which is the final part, will be next Thursday on the 16th at 6 p.m. same time on Zoom. And this is the registration link. And I will also just once again, give me 1 second to drop the link in the chat. If you would like to grab the link and register. Hold on 1 second. Okay, I just dropped it in there. Feel free to grab that. And yeah, we're going to circle back now to just one more chance if anyone would like to get a screen grab. It's going to be up for a couple more seconds. But yeah, we're going to circle back to questions now. Let's see. If you can, feel free to use the chat, the Q&A function, or raise your hand. If you raise your hand, then I'll be able to give you the permission to unmute yourself and ask your questions verbally, if that helps. But somebody asked, Kendra asked, my cousin is living with me and is an international student. Can an international student be claimed as an adult dependent on my IRS taxes? I'm going to open it up to either one of you to respond.
You're muted, Rajan.
Yeah.
Okay. If the person lived with you and is your relative, distant relative, whatever, he lived with you and you supported him while he's going to school, regardless of his citizenship or wherever he is, he doesn't have to be, but he has to be a resident in the USA while he's going to school. Yes, you can claim him as a dependent.
Charles, would you like to add anything onto that?
No.
Okay, great. If you guys have any more questions, somebody asked, is a copy of the presentation available? So the actual presentation itself is not available for distribution, but if you would like, you can either email, I will drop my email address in the chat. Give me 1 second. You can send an email, it doesn't have to be anything specific. You can just say, I would like a copy of part 2 of the Need to Know series 2022 tax season webinar. Or there's another option. You can go to Brooklyn Legal Corporation A's YouTube page, and part 1 was uploaded from last week, and you can watch that there as well. And part 2 will be uploaded as well. It should be up around either tomorrow, and if not by tomorrow, then definitely by Monday. So those are the 2 options that you have in regards to getting the recording. We have another question in the chat. Somebody asked, so what do you use for Social Security number alternate? So an alternative, I'm assuming they mean.
It sort of depends what you're referring to. You know, a Social Security number is a pretty unique number. So a unique type of number. If you simply need to file your taxes, but you don't have a Social Security number, you can obtain what's called an ITIN number. It's basically an individual taxpayer identification number. If that's what you want to do. If you're
I'm sorry to interject. They added more context. They said for the international student question. So I'm assuming if that person doesn't have a Social Security number.
Okay. Yeah. So, I mean, it sounds like there's some. It sounds like a great question, and there's a lot going on with that. You know, if you'd like to do a consultation, we can do that and talk more about what your particular situation is. if you want to send an email to, you could send one to Grow Brooklyn, or you could send one to us at info@bka.org. You could also give us a call at 718-487-2300. And so these are the types of questions that we do look into to provide answers to folks who have questions, but it's not always easy to do it in these types of presentations because of all the different facts and things.
Yes, definitely. Rajan, if you would like to add any more context to that, but if not, that's also okay.
Well, if anybody wants to contact me, you can go to rajan@growbrooklyn.org or call the number 347-682-5606. And we'll try to answer you within a couple of days.
So I'm going to begin to wrap up. If I see any other questions pop up, I would kindly ask, though, if you do have a question, the raise hand function. I'm not going to be checking that right now, so I won't see if your hand is up. So if you could kindly just keep it to the chat and the Q&A, since we're winding down to an end. But I just want to say thank you so much to Charles and to Rajan for showing up for the community and offering up their expertise, their knowledge, their services, and all of that to all of us here tonight. We all really appreciate that. I want to thank Andrew Wright, who had to hop off for a meeting, which is totally understandable, for showing up for the community again on behalf of Councilmember Hudson. I want to specifically thank Councilmember Hudson and her team and her office and all of her efforts for supporting us, for sponsoring our event. We always appreciate the support from our community leaders. And finally, I want to thank all of you for taking time out of your evenings to join us, to sit down with us, ask your questions, and share anything, all of your information from the beginning about where you're calling in from and why you decided to join us. Once again, this is part 2 in a 3-part series. Just to do a little recap of all the information, hopefully you were able to get a screen grab of the contact info. Hopefully you're able to grab a screen grab of the flyer if you would like. Councilmember Andrew Wright, on behalf of the council member, dropped in his contact info for their office and their team. So if you would like to contact Councilmember Hudson, that info is also in the chat. I suggest copying and pasting it. Give me 1 second. I see something in the chat. Oh, no problem, Martha. Thank you for coming. Good night. But yeah, I hope everyone, got a lot out of this, got as much out of it as we get out of it. And we really appreciate it. If you have already registered for part 3, share love the Brooklyn way, send a link to a friend, send a link to a family member who you think might, find this information beneficial. Next week, as I said earlier in the call, we'll be joined by New York State Assemblywoman Farah Sue Forrest, who represents the 57th Assembly District, and we'll be covering worker classifications, self-employment obligations, as well as the Taxpayer Bill of Rights. So if that sounds like information that you, your community, your family, your friends, anybody would benefit from, we suggest sending this information over to them, sending them a screen grab of the flyer, the registration link, whatever works best. But yeah, thank you all for joining us. Thank you, Charles. Thank you, Rajan. And if you're traveling home, please travel safely and have a great weekend, everyone. Thank you so much.
Good night.
Thank you.